It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Well, it's no surprise considering all that's happening in the world these days, but socially responsible investing has started to become a trend on Wall Street and with investors in the past couple of years. What does it mean, and is it wise? That and more this hour on Wise Money.
That's right. So we're gonna break that down a little bit, tell you what it's all about, and sort of debate its merits coming up here. If you have a question, we're going to be hitting several questions from fans of the show, and also specifically some insurance questions, because we want to thank our special sponsor for today, Auto Owners Insurance, who are sponsoring this show. We appreciate that, Auto Owners. If you have a question for us, we'd love to hear from you. You can call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com. Submit a question right there on the right. And then all over social media, that's an easy place to submit questions. That's where most of the questions come from. And so you can find us on Facebook and Twitter and the YouTube channel. Just search The Wise Money Show. All right. At its surface, if you hear socially responsible investing, you're like, yeah, of course, that makes sense. And actually, it doesn't make sense at all. It is extremely confusing. And there's a few different categories. I mean, socially responsible investing is different from impact investing, which is different from ESG investing, which is, all it's not standardized. And so anyway, it can be quite confusing to the average investor. What does this mean? What is it? And then let's talk about its, debate its merits here.
I think of socially responsible investing, or some people maybe use the phrase socially conscious investing. You mentioned ESG, which is actually an acronym for 3 different types of screens that might weed out certain investments that you would own. It stands for environmental, social, or governance. But all of these, whatever acronym you want to use, whatever label you want to place on it, it's basically a methodology for picking what types of investments you want to own based on more than just, hey, do I believe that this is a good investment that's going to generate a great return? I want to screen out investments for other more qualitative rather than quantitative reasons. And it might be that you want to only own stocks, for example, in companies that either encourage certain causes or movements that you really believe in and you want to be behind, or maybe they avoid certain behaviors or activities, that kind of thing, that you really don't want to be a part of. Mm-hmm. And so the point here is it's a screening system. And it's saying of all the thousands of companies or all the thousands of different investments out there that you could select from, you're saying I want to kind of weed out the ones that don't align with my own personal values, and then select from the ones that are remaining. And then a more traditional approach to investing begins with, is this an investment that I think is going to generate a rate of return that will compensate me for the risks that I'm taking? So it's just a different approach. It's a different process that you would go through for picking your investments.
And we're going to get into some of the challenges with this, but off, right at the cusp, it's so there's sort of 3 different categories of this. And so ESG, Josh already mentioned that's an acronym for environmental, social, and governance. And how that's defined is you're screening and you're only investing in companies that have certain environmental, social, and governance sort of standards, and so you're screening out those that sort of meet those standards. Now, that's separate, is very closely connected to, but it's separate from socially responsible investing that looks actively at removing or choosing specific investments based on their ethical guidelines, and that could be alcohol, tobacco, guns, those sorts of things. And then finally, there's a third category that is called impact investing. And this all sounds the same, but impact investing is actually looking for businesses or organizations to complete a specific project or to tackle a certain need that a community or a mankind or people group has. And so we're going to create an investment to just make an impact on X community and do this sort of thing, bringing water to this area or solving pollution in this area. And they're raising investments and support towards that. So
that's a cool concept. I mean, it's almost saying, hey, I don't want to leave it up to government, for example, to go hit these certain causes, or maybe you're just looking around and there aren't certain charitable organizations that are getting it done. And there are many folks who believe that a business with an economic incentive still can go achieve great things just because of the nature of trying to be efficiently run and well structured, very focused on that mission. So impact-based investing like this, it may resonate with a lot of folks.
Now, would you throw Tesla in the impact investing? I mean, where Tesla, at least for the vehicles, they're trying to have zero emissions. I mean, so that's the impact they're trying to.
You might say, hey, I want to invest in something that's moving us away from fossil fuels.
Right.
The problem with Tesla is the environmental damage that is done creating the batteries that their cars use.
Now,
so I mean, this is the problem: is that by solving one potential problem, you might create several others. And I would encourage you to say, if you were going to invest in Tesla, the first screen that I would use wouldn't be the social screen, it'd be the financial screen.
Right.
So I mean, because if you said, hey, they check the box for how I look at the world and approach the world socially, but they're a horrible investment, would you really want to do that? Mm-hmm. I mean, this is the degree of complication. It sounds great, and I actually had a client that came to me, and he had retired. He was a professor, and he had gone to an investment seller and bought investments. And this person that pretty much sold investments, I wouldn't call him a financial advisor, but this person that sold investments screened and came up with about 11 stocks to put $1 million into.
Wow.
And so the concentration that this guy had, and I personally call that career risk, because what happened was his portfolio did horrible.
Yeah.
Absolutely horrible. But he said, hey, I don't want to do anything with a company that might have something to do with abortion. Mm-hmm. And he had his list, and I said, well, that's great, but I mean, really, almost the only way to get that the kind of purity you might be hoping for is to create your own, I don't know what it is, have your own business,
right,
or fill in the blank, because anywhere you go beyond that, there will be an influence, and you will be linked to seemingly unrelated things where you say, wait a minute, my money is going to help that. I own stock in that company. I own stock in Apple. So my money is going to slave labor to build these iPhones. So I mean, all of a sudden,
I mean, that's part of it. Now we're gonna get into this, and we're also not just poo-pooing the idea. I mean, as Josh said, this is a very noble idea. Pulling it off is very tricky and has some complexity. So we're going to get into all of that and more coming up here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. What you're watching right now is our 1-hour talk show that airs here every Saturday morning at 10 a.m., so check it out. And then also throughout the week, there's smaller nuggets, about 8 to 10 minute Next Wise Step Concepts, where we're talking about a specific financial issue, something going on in the world of finance or anywhere in between, and how to apply it to your financial life. So if that sounds good, make sure you hit that subscribe button, turn on notifications. We appreciate that. So, okay, I've got 3 big problems with this that you've got to overcome. And then I think we do need to tell people, if this is appealing, here's what you can do. Mm-hmm. Okay, so does that sound like a fair place to go?
Yep.
All right.
Excuse me.
Let's do it. Socially responsible investing, or even ESG type investing, it's getting a lot of publicity right now, trending very much, however, very complicated. We're getting into that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFG studios, Kevin Korhorn, Josh Gregory. Every episode of the Wise Money Show is on podcast, so if you love podcasts, please check it out. You can listen to the entire library right there, Spotify, iTunes, wherever. Just go and search the Wise Money Show with Korhorn Financial Group. Rate the show and leave comments there. We appreciate that. All right, so we're talking about the big emerging trend of socially responsible investing, SRI, which is a little bit different than ESG investing, environmental social governance, which is also different from impact investing. Now, there are, in my view, 3 big challenges with this. But then also, we all want to have a positive impact, don't we? Don't we? I think so.
In a vacuum, of course.
Of course. And so with that being the case, if this is appealing, what can you be doing about it? So the first challenge that I see with this is I often have had conversations with people, and I see this a lot in this trend, where people say, I want to do ESG investing or socially responsible investing because I don't want my money going to help these to fund these causes. Like Kevin, you mentioned, the facilities in which they make the iPhones. Well, I don't want to invest in Apple stock because I don't want my money going towards those sorts of endeavors. And I would argue that's not what you're doing when you're investing. That's what you're doing when you're consuming.
When you buy the iPhone.
When you buy the iPhone, right. That's what's happening.
Yeah, that's
but
true.
When you invest in Apple, you're just buying someone else's shares. By you investing in Apple, you're not giving money to Apple. You're not funding those causes. You are when you're buying those. So the thing that I've thought was just quite interesting, Nike, of course, has made it part of their marketing, and they've really stood up to some of the issues that we're facing right now. And yet it's been long understood that the folks that sew the Nike products, right, are, I had someone say, isn't it interesting, on the back of the NBA jerseys, some say equality. What if you were the individual stitching that into those jerseys, making less than minimum wage in a sweatshop somewhere, typing or stitching in equality? Mm-hmm. And so, though it's when you're making purchases, when you're consuming, that's when you're actually giving your dollars to certain businesses, and you need to be aware of that as whether you're supporting or not. When you're investing in a stock, that's typically in the secondary market. You're not actually giving your money to that company.
However, there is maybe the rebuttal to that would be there are some folks who really feel it really tugs at their conscience. They don't want to profit from those activities either, right? And actually, I was standing in a group at church. We had masks on. We were socially distancing, all that. Don't worry. But the conversation came up after a service, this very topic. Hey, Josh, what do you think about socially responsible investing? And some other comments were shared and opinions that, you know what, this for many people is a faith issue even, right? And they believe, hey, I'm going to be held accountable someday for how I stewarded or how I managed what I believe is God's money, not just my money. And so for them, if you believe that to be true, they might draw the line as, I don't even want to profit off of certain activities, and it could be I don't want to have anything to do with alcohol. I don't want to have anything to do with maybe defense stocks. Maybe I don't want to have anything to do with drugs or tobacco or something. The point here is that everyone has their convictions.
Yep.
And they have their values, and it could be as a consumer you don't want to buy from companies that do this. It could also be that you don't want to invest in companies because you don't want to profit from them.
And that goes to the second big challenge that I see with this, and that is your social concerns and your social your empathy towards certain issues, that's unique to you. Now, you might share some of those in common with someone else, but I don't think there's a universal standard for this is socially responsible and these things aren't. That's up to each individual person. And Josh, you nailed it. I mean, oftentimes what is mainstream social issues, oftentimes, are different than the social issues that Christians have, right?
Sure.
And so just saying I don't want to have either profits or fund these sorts of activities, so therefore I should be in socially responsible investing, you actually might go to be funding things that are against your social responsibility just because they fit someone else's social responsibility.
They defined it differently than you, right?
Exactly. I Kevin and I remember, I think he turned me on to it. I listened to a podcast, this is a couple years ago, about someone detailing the various nuances of our own socially empathetic choices or feelings. And when you try to invest based on that, it's almost no investment strategy at all because it is changing so quickly. Yeah. What's socially responsible for one person is very different for another person, very different for another person, very different for another person. So in practice, just simply buying a socially responsible mutual fund, I don't think is a way to pull this off.
And to me, I would say if you go back in time about 20 years ago, this became an issue when people were talking about tobacco, because tobacco was the big killer and Philip Morris was the evil giant with tobacco. And they would say, I want to have a mutual fund, but I don't want it to own Philip Morris. And I would say to them, so how do you feel? Like, do you guys like Kraft macaroni and cheese? You like Jell-O brand pudding and pudding pops? And that's when Dr. Huxtable was the spokesman for that. I mean, that was a seemingly more innocent time. Little did we know. But when you looked at that, I'm like, okay, so yes, you don't like the Marlboro Man, and you think that anything that you can do to punish a company that has something to do with that would be a righteous thing to do. But you're still buying Kraft macaroni and cheese and these pudding pops, and you're giving a direct payment to Philip Morris by putting that stuff on your table, yet in your portfolio you say, I won't own Philip Morris. So my only point is, which I think we've been kind of making a little bit, it is nearly impossible to pull this off in a way, because in 1987 Philip Morris didn't own Kraft, and in 1988 they did. Yeah. So you say, okay, now what? Yeah. Now do I go and sell a position in my portfolio? So
I've shared with you guys before. One of the coolest experiences that I had when I was in college was being a part of an internship where I got to help a company that does socially responsible investing do the screening or the searching, kind of looking for dirt. I felt a little bit like a private investigator, a detective or something. You can find something on every company.
Yeah.
And there are reasons to screen every stock out of a portfolio if you allow it. And that's what makes this so difficult. It has to be your values, not someone else's.
That's right. So it's hard to standardize those across the entire investor universe. And so there's an additional one additional main risk that we got to hit on. And then for those of you that are interested in this, what can you do about it? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. For YouTube, this is, I got to make sure that we don't come off sounding like socially responsible investing is bad. And certainly socially responsible living is bad. Absolutely not. Of course. We should all be doing our part and doing our very best. It's just the point is, it sounds easy and noble, and yet the execution is terribly confusing and problematic for the exact case that, Kevin, you just mentioned. And really, if you were to merge together what you two both said, you can find something on every company, and one day a company is into tobacco, the next day they're in mac and cheese. It's just, to pull this off, it's just unbelievably complicated.
So here's one advantage or one benefit of those socially responsible mutual funds, for example. When they're not just screening out stuff because of bad things happening, but they sometimes will even go in and purchase companies that they believe they could have influence in. Because if you're buying hundreds, maybe thousands of shares of a company, you suddenly have a voice on the board even.
Yeah.
And you have some steering capabilities on what kind of activities, what kind of behaviors, that sort of thing. So becoming almost like an activist investor is one approach with some of these mutual funds, and they see it as a chance to have influence and to change how companies are run.
Yeah. And honestly, that would be the primary way that I would recommend someone, if they're interested in this, do it, is if you've got enough resources, identify the companies, make the individual investment in the stocks, and try to gain influence that way. But that weeds out a lot. I mean, that weeds out 99.9% of all investors.
Yeah.
But in my opinion, that's probably the only way to really, really pull this off, to pull off what this is, what ESG investing is actually saying. Because then you can specify your ESG criteria, and then actually have a say in it.
Yeah, unless you just said, "Hey, here's what I'm going to do. I'm going to look for an ESG fund that is acceptable." My issue with that is what's my purpose for investing, and am I looking at certain sectors that I'm investing in? Because if they basically can go anywhere, I really have no idea what I'm investing in. And so if I've got an ESG fund that focuses on energy and financials, I'm down 30% this year.
Yeah.
So you say, well, it's worth it to me to be down 30% because I know that I'm not doing anything that is against my conscience.
Yeah.
Well, so I don't know. I feel like all we do is muddy. I think you could say if I used ESG, if it doesn't have to be perfect, then you could use a fund because it won't be perfect. You just have to know it won't be perfect.
Yeah, that's great. I would encourage you to say that when we open it up here. So, all right, we'll wrap this up. Hit a
Which questions are we running into?
I don't know. I haven't even looked at them yet.
Okay, we'll do those.
Okay. All right. Thanks for being with us today. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFC studios, Kevin Korhorn and Josh Gregory. Stay connected to everything Wise Money. Find us online, wisemoneyshow.com, or check us out on wherever you're at on social media. We are there as well, Facebook and Instagram and Twitter, all that sort of stuff. So stay engaged, stay up to date on all Wise Money content. Find us there, follow us, and leave comments and questions there as well. Speaking of comments, gosh, if you could just filter the number of social media contents related to social issues this year, I'm sure we've broken a record. And just the social issues that are happening and taking their centered stage publicly, that's led to more and more people being interested in socially responsible investing. We're defining that today and actually talking about the challenges, and there's 3 major challenges, and we've hit the first 2. Now the third, to me, is it's hard to universally apply it. So imagine you've got your 401k and it's appropriate for you to be investing there, and the only investment options you have in the 401k are index funds. Now with index funds, you own everything in the index. And so you say, well, I don't want to have, I want to have a socially responsible screen, but then when you look at the actual owning of the index, you own 0.021% of a company that maybe you don't want to own. And you say, well, gosh, is it really worth it for me to screen out an index for something that is a fraction of a fraction of a fraction of a holding? And so it almost, in some areas, specifically 401ks, where your investment options are limited, or target date funds. I mean, these are other trends in investing, index investing and target date investing. Mm-hmm. And it's hard to, and you'd probably say impossible, to have a socially responsible screen in every area of investing. Index investing, it's pretty much impossible, and target date investing, it's not possible. So therefore, it's not really possible to do this in your 401k, simple IRA, those sorts of things.
I think I would agree with that, or at least you would have to turn to see if maybe your 401k has a brokerage window built into it or something. Mm-hmm. And this is basically a way for you to use a portion or all of your 401k money, the dollars you've accumulated in that account, to invest like a brokerage account, where you can go out and pick different investments that aren't in the normal lineup that your employer selected. Maybe that could be a way for you to direct some of your investment dollars in the retirement plan towards this socially responsible approach.
If you have that available.
If you have it available, and many don't.
Right. And again, when you start at the very beginning and you say, how do you make your investment decisions? If the investment decisions are, I want to invest in the very best companies in the world that will give me the best opportunity to reach my financial goals, that's one approach. And so then you look at various sectors and different areas geographically that you'd want to be invested, and different size of companies that you'd want to be invested in. So there are all kinds of screens there. Or you could say the thing that matters to me is, I want to have ESG, I want to have these types of funds and invest in those. The issue becomes, if you've got something outside of your 401k where you're doing ESG and then you have an index fund, you can have portfolio overlap, you can have unrewarded risk. There are all these things that we could kind of nerd out on, this is what I would encourage you, if you're really passionate about ESG investing or socially responsible investing, whatever, work with someone who can help you on that and can keep an eye on the things that your eyes aren't really looking at, mm-hmm. because that it's important so that you don't get kind of bushwhacked.
Yeah.
That's not a technical term, but you know what I'm saying.
I actually, yes. So for those of you, and we're talking about the complications. We're not telling you this is a terrible idea and, it's awful. But we're talking about the challenges with it. So for those of you that say, hey, actually, I want my investing to have this socially responsible screen. Yeah, work with your certified financial planner. I mean, one of our, actually 2 of our investing strategies, we use mutual fund companies that currently meet our investing screens that actually have socially responsible screens as well. And so we could help if that's something you're interested in. Well, I would just go back to, I would go back to the challenge. I would have you, if this is a sensitive part for you, I would say you can have more of an impact in ESG and socially responsible consumption than investing. Because with investing, your dollars are not going to fund those activities, but when you are consuming those products, you are directly funding those activities. And so and this isn't a cop-out, but the social stuff right now going on in America it's unbelievable what we're facing. And we all want to do our very best. And I would say that's going to have a much bigger impact in your consumption than it will in your investing.
So I like the idea of socially responsible consumption and financially responsible investing.
Yeah. Yeah.
Because for sure, the direct payments to the company when you buy that product are much more beneficial to that company than if you bought that company's stock.
Yeah, yeah. And then the other way to really, really pull this off, in my opinion, the purest way to really pull this off is for the small minority of individuals that have been blessed with enough resources to then screen the actual companies that stand for the specific issues that you want to avoid or be a part of, and invest enough in those direct stocks that you then have influence in how the company is run. Now you might say, world doesn't work that way. Actually, that is what it is. I mean, when you own stock, you were part owner of the company. And it's just rarely do we own enough, does the average investor own enough to actually have a say in how things are going. But if you were to really pull this off, true socially responsible investing, since we all have our own social barometer, you could screen out companies that actually stand for what you care about, invest a lot in those, and be influential there. Now, I don't have the resources. I haven't been blessed, and I'm not stewarding those resources. Many of us aren't, but that's really the way to pull this off. So, all right. I hope that helps. We're going to transition to a few questions from fans of the show. We got the first one here from Ali, 52. Ali, 52, California. Submitted it online. What are the benefits of custodial Roth IRA? Would this be the best type of account to open for my child? Or is there a different plan?
Great question, Ali. So the question is, what are the potential uses, and what needs to happen in order to be able to invest? So there are a number of custodians that will not allow a custodial Roth IRA. So first of all, you got to find a custodian that will allow a custodial Roth IRA.
A lot of companies, unless they're 14 years old or older, they have an age that they draw the line.
Yeah, a lot of companies say 18.
Mm-hmm. Yeah.
A lot of companies, as in one that we work with a lot. Mm-hmm. So if you want to do that, you might be creating some complexity. The other thing that's necessary to fund a Roth IRA that's not necessary to fund a 529 is the child has to have income.
The individual
earned income,
has to
paycheck
have
money.
Yeah, that's right.
Right.
That's right.
So if the child has income, it might make a ton of sense to fund the Roth IRA in a custodial account on behalf of the child.
That's right. And then you also know what's the purpose of this money. You got to figure that out as well. So we're going to pick that question back up and then also hit a few insurance questions. That and more coming up on the Wise Money Show with Korhorn Financial Group. So I have a friend named Ali, and that it's spelled the same way. I'll just say that. Okay. So I look at that and my brain says Ali. All right.
Oh,
Hot in here?
Yep, we got to go. 13 minutes.
yeah, they don't call him Muhammad Ali.
That's right. That's right. All right, we got 13 minutes, and that gets us to the time you need to.
Yeah, let's go.
All right, let's do it. What kind of deductibles should you have when you're picking your insurance? Good question. From a fan of the show, we're going to answer it right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFC studios, Kevin Korhorn, Josh Gregory. Want to say special thank you to our sponsor of this show, Auto Owners Insurance, specifically sponsoring this segment of insurance questions from fans of the show. Thank you, Auto Owners. Check them out with your local independent insurance agency, such as ours. So check it out. All right. So before we get into those insurance questions, anything else for Ali, 42 from California, what are the benefits of a custodial Roth? Should I use this account or a different type of plan like a 529 plan? I mean, the other thing is if the money's for college, then the 529 plan would likely be a better use than the Roth IRA. Now, they both can be college funding tools, but on the order of benefit, you'd probably say the 529 has slightly more benefit than the Roth if the money's for college.
Yeah, you don't want to lose sight of how financial aid calculations are run, that sort of thing, because assets and income in a child's name are treated differently than the assets and income in a parent's name. And 529 plan and Roth dollars, they might be looked at differently by the colleges when they're running these calculations as well.
Yeah.
And the difference, one of the differences is that the Roth IRA, the custodial Roth IRA that your child would own, and it would be, that money would be in their name. You wouldn't do that with a 529. The 529 you would own, and the child would be the beneficiary of that.
Yeah.
So it's actually very different.
It's very different. So you'd start by asking the question, what's the purpose of this money? What's the purpose of this money? And then you've got to go through some of the qualifying, well, it's hopefully for long term, Well, then we'll use the Roth if that child had earned income. That could make a lot of sense. If the money is for, a down payment on a house, I wouldn't use either of these. If the money's for college, consider the 529. You got to figure out what's the purpose of this money, because you could take a very very good idea like the Roth IRA or 529 and have it be disastrous if you use it for the wrong purpose.
Right. So think in terms, Allie, if it's the child's money that they've earned, the Roth IRA is likely a great potential candidate. If it's your money that you've earned and you're eligible to contribute to a Roth IRA, then that might be something to consider for you yourself, because that's where you have to decide, Allie, do you want to put money into a 529 or a Roth IRA on your behalf?
That's right. So certainly financial planning question. It totally is. So, all right, again, with Auto Owners as a sponsor, we got a couple of questions here from fans of the show that are insurance related. And I love this one. Let me tell you a quick story. So I had an individual come in who's a fan of the show. And they came in and said, "Hey, we need some help. I've done this myself for a long time, but we're now reaching the point where we need to make some big financial decisions, and I feel like I've taken us as far as we can go. And I need someone who does this all day, every day, who has ideas that I don't have and can help us." And we sat down, we laid out our ideas, and it was a powerful couple of meetings, and we're moving forward. And when it got to their insurance, this individual's been preparing for retirement. He's got about $175,000 in cash in the bank and CDs. And you look at their the insurance, and they had $100 deductibles on their insurance. And you'd say, well, wait a second. Now, if I get in an accident, I don't want to have to pay out of pocket. So I get that. However, for that luxury, I have to pay more premium for my auto insurance all along the way. And when I've got that much money sitting in cash, I could technically afford more if I'm in an accident, more out of pocket. And because of that, I should be paying less for my premium, less for my auto insurance. Mm-hmm. It's just inconsistent. So how do you determine what deductible is best?
Well, there are a couple of ways to determine, but I think you want to think about what is a deductible. So a deductible is those are the first dollar. When there's a loss, I'm paying the first dollars. So the question is, do I want to pay the first 100 or the first 1,000? And when you have insurance, there's a low probability that a high cost loss will incur. So if there's a low probability that it will occur, I really want to bet. Now we're at the betting table. So I want to bet that I'm not going to have that event. But the other thing is, I don't want insurance to be close to my first dollar of coverage. It's called self-retention. I want to retain some of that risk for my own self because it changes what I pay for my insurance.
Yeah.
Right.
So if it changes what I pay for my insurance, instead of having a $100 deductible, because with a $100 deductible, I'm making a bet that I'm going to have that event. Mm-hmm. I'm betting that I'm going to have the event. And oh, by the way, if I have the event and I have a claims history, it's likely that my insurance is going to go up anyway.
Hasn't, though, that bet, I mean, insurance companies have already done all of the analysis on that bet, right? They hire actuaries to do all of the statistical analysis on that probability, and that's called your premium. So the bet is actually factored into your premium. So I think you're right, Kevin. Will I get in an accident today? Yeah, we all have those, that risk. But the bet is been placed on the amount of premium. That's how it's already been factored. So your ability, so I look at your deductible choice as more so your ability to cover that amount of loss if you had
So you're
one.
pointing more to what kind of cash do you have on hand? What emergency fund are you operating with? Would it create a hardship to you to pay the first $1,000 or the first $2,000? I mean, you fill in the blank, depending on whether we're talking about car insurance or home insurance, that sort of thing. You pick maybe your deductible with the thought in mind, what if this does occur? Is it creating a hardship or am I ready for it? And certainly the example that you gave, someone who's got $175,000 liquid at their fingertips, probably we could argue it's not a hardship if they were to pay the first $1,000. But I would add one more wrinkle to this story problem, because just because you can handle a higher deductible doesn't mean that you're necessarily being rewarded real well for it. Because sometimes we actually crunch the numbers and we say, okay, if you were to take this deductible, say $250, here's what your premium would be on an annual basis. But what if we bumped it to $500? So we just doubled it. How much does it save you? What if it barely saves you anything?
$1.
Yeah, I mean,
Every
just
6
almost
months.
a rounding error at that point. If you're not actually being rewarded for taking that extra risk onto your shoulders, maybe it's a bad idea. So this is where, it's important to us that these insurance decisions should be made in the context of your financial plan, because it has an impact on your present financial position and what kind of assets you have, but also on your cash flow.
So here's where a bad idea becomes a good idea. So we had some friends, and they had some water in their basement, claim paid. Then a high wind came, and the neighbor's trampoline blew onto their roof or something crazy like that. Another claim paid. And then they hit a deer. And all within the span of maybe 6 months.
Geez, sounds like Josh Gregory.
Jeez.
That guy's a walking loss.
And so
Not even true.
no, Josh is a winner. So here's the interesting thing. Their insurance company non-renewed them
Yep.
because of the number of losses. And this is where, if you take the mindset to insurance and you say the first $1,000 on my car, the first $2,500 on my house, I'm responsible for, and I'm going to make preparations in order to pay those. It does slow you down and keep you from doing a claim. And you say, well, wait a minute, that's what I have insurance for. It is, but you have to understand the game, because I had an issue, boom, I have a claim, issue, claim, non-renew. So I wouldn't approach this as a fear monger and say, well, don't you ever make a claim on your insurance. But I would say, I can tell you this, I've seen a number of circumstances where the $1,000 deductible had the person, writing a check for $900 to get that little ding fixed instead of turning it into their insurance. And I've seen the situation where the the cash price to get the basement dried out was it was less than if they had turned it into the insurance company. And the company doing the restoration work said, hey, listen, we should just turn this into your insurance company because and they were going to turn it in for
They write bigger checks.
right. And so that sounds kind of stinky, but that's kind of how the world turns, unfortunately.
I've talked to someone about this recently, and I remember their response when you start peeling back the layers of the onion on how insurance works, and their response was, "This is a racket," and and I would just tell you, it just feels like insurance really is there for those big losses. It's really, really there for those big losses, and you might say, "Well, that's not fair," or we would encourage you to have a stable financial house be for the small losses and have your insurance there for the really, really big losses. Okay, really quick, got to sneak this in. How important is it for your umbrella policy to cover un- and underinsured motorists? Just give me your quick response. How important is that?
1,000% important.
2,000% important.
Wow, Josh gets it. Josh
I
is
win.
the winner. Now, but here's
2001.
Here's why this question is so interesting, because many of the big like these companies, they don't offer it. On your umbrella, you get this extra protection, and right there on the front page, un- and underinsured is not covered.
Yep. Just saw this just yesterday, actually.
I saw it too. I had a client who was thinking about selling his motorcycle, came in, brought his declarations pages, and had no uninsured, no underinsured, and he had 25-50 limits. And I said, you can't leave here without getting the right insurance in place. It's like, well, I wanted the minimum because I didn't know if I was going to sell it.
It's wildly important, and a lot of big companies are omitting this. You need un- and underinsured motorists on your umbrella policy. All right. Thanks for the questions. That's all the time we have for today. On behalf of Josh, Kevin, myself, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.